Welcome back to the deep dive. Today, we are looking at a collision, and pun intended there, between high finance and, well, sci-fi technology.
Right.
For decades, we've all been hearing about self-driving cars. It's always been this thing that's like 5, 10 years away.
Oh, it's just around the corner.
Exactly. But today, we're going to look at how that tech is directly impacting your wallet and the stock market, like right now. Specifically, a massive shift that happened in January of 2026.
It's a really fascinating moment. We're sort of moving from the theoretical phase of automation, the wouldn't it be cool if phase, to the actual financial implementation. And the numbers we're seeing are staggering.
Absolutely. So the subject of today's deep dive is lemonade. And no, we aren't talking about the drink.
Not the drink.
We are talking about the digital insurance company, ticker symbol LMND. And if you were watching the markets in January 2026, you saw this stock just absolutely take off.
It surged 21.9% in a single month. I mean, that is a huge move for an insurance carrier.
Right.
Usually, insurance stocks move like glaciers. They're slow, steady, predictable. They're supposed to be boring.
But this was a rocket ship.
A total rocket ship.
And that's our mission today. We're going to unpack why that happened. Why did this stock jump almost 22% in January? And I think maybe more impressively, why is it up 138.3% over the last year?
Yeah.
Because, spoiler alert, it's not just about quarterly earnings. It's about a very specific new product launched for Tesla owners that, well, it fundamentally changes the whole insurance paradigm.
It does. It connects the dots between how you drive, or maybe more accurately, how you don't drive, and what you pay for insurance.
It's the first time we've seen this direct financial link between your bank account and the robot chauffeur.
Right.
Exactly. So whether you're an investor looking at the numbers, maybe you're a Tesla owner wondering about your premiums, or you're just curious about when the robots are taking over, this story is for you.
It's really the story of how insurance companies are placing a very, very expensive bet that robots are actually better drivers than we are.
And they are putting their money where their algorithms are.
They certainly are.
Okay, let's unpack this. Because before we get to the shiny new robot car plan, we have to set the stage. You can't really understand that 22% jump in January without looking at the year leading up to it.
That's right.
This stock has been on a rampage.
Rampage is definitely the right word. As of January 19, 2026, Lemonade stock was up 138.3% over the previous 52 weeks.
Wow.
If you just look at the chart, the 52-week low was way down at like $24.31.
$24.
And by mid-January, it's hovering around $80.48. That is a completely different stratosphere.
That is wild volatility. I mean, going from $24 to $80, that's life-changing for early investors.
It's a 3x or 4x return in a year.
But was this all just hype?
Yeah.
Just about the future? Or was the business actually getting better? Because Lemonade has, historically been a bit of a battleground stock.
It has. People either loved the vision or they hated the losses, and that's the important context. Before this news drop in January, the market was already bullish on Lemonade. Okay, this wasn't some meme stock situation. The fundamentals were actually improving. If you go back to their earnings reports from August and November of last year, they showed really strong sales and positive earnings surprises.
So they were actually making money, or I guess losing less of it, better than people expected.
Precisely. And in the insurance game, there are a couple of, kind of boring but critical metrics you have to watch.
Right.
One is gross earned premium, which is basically just how much revenue they're collecting from customers. That was up. But the more important one, the holy grail metric, is the loss ratio.
Okay, break that down for us. I know loss ratio sounds like accounting jargon, but it's really the heartbeat of an insurance company, isn't it?
It is. Simply put, it's the difference between the premiums you collect and the claims you have to pay out.
Okay.
Think of it like a bucket. You fill the bucket with premium dollars. But there are holes in the bottom. Those are the claims, the car crashes, the stolen laptops.
Right.
If you collect $1.90 leaks out to pay for those claims, your loss ratio is 90%.
Which leaves you 10 cents to run the whole company. Not a great business.
Exactly. You want that number to be as low as possible. And in late 2025, Lemonade showed significant improvements there. They were plugging the holes in the bucket.
Which implies they were getting better at underwriting, at picking the right customers to insure.
It does. It means their AI was getting smarter at predicting who was going to crash and who wasn't. So even before the self-driving stuff, the company was proving it could actually run a profitable insurance business.
So the skeptics who said, oh, they're just a tech company pretending to be insurers, they were getting quieter.
Much quieter. The market cap had grown to $6.0 billion. The trading volume was healthy. So when we entered January 2026, the stock was already primed.
So the pot was already simmering.
It was. In fact, just before the new product launch, the stock was already up 9.9% for the month of January alone.
Okay, so investors are happy, the business is solid, and then on January 21, Lemonade drops the hammer.
This was the catalyst. This was the match that lit the fuse for that final surge to 22%. They unveiled the Lemonade Autonomous Car Plan.
Let's talk about what this actually is.
Yeah.
Because on the surface, it sounds like just another insurance policy, maybe a gimmick, but the mechanics are totally different.
They are. It's designed specifically for Tesla vehicles. Now, Lemonade already had a model based on paying per mile, usage-based insurance.
Right, drive less, pay less.
And they already had discounts for EVs generally. But this new plan introduces a specific reward for hands-free driving.
This is where it gets really interesting.
Yeah.
And we're not talking about cruise control here.
No, not lane keep assist. We're talking about full automation. The deal is simple, but it's revolutionary. When the car's full self-driving feature FSD is active, your mileage fee is cut in half.
Wait, 50% off?
50%.
That is wild. So let's play this out. I'm on the highway. If I keep my hands on the wheel, I pay full price.
Right.
If I double tap the stock and let the computer drive, I pay half price. It's literally a financial penalty for being human.
That's one way to look at it. Or a financial incentive to trust the automation.
Yeah.
And we need to be clear about how this works. This isn't the honor system.
Right. I was going to ask, how do they know? Do you plug something in like that old progressive snapshot thing?
No dongles, no hardware. It relies on a direct data feed. Lemonade has integrated its systems directly with the data sensor system inside the Tesla.
So the car is just streaming data to the insurance company in real time.
Exactly. It knows the second you engage FSD and the second you take the wheel back.
That level of integration is fascinating.
Yeah.
It's like your car is constantly negotiating your bill for you. Oh, he's letting me drive now. Tell Lemonade to apply the discount code.
It creates this seamless feedback loop, and for the listener, this is why we call it a paradigm shift. Traditional insurance relies on historical data, proxies for risk.
Your age, your zip code, your accident history.
Right. They're guessing how safe you are based on who you are. You're a 25-year-old male, so you must be reckless. But this model, it relies on real-time behavioral data. It prices the risk based on who or what is controlling the vehicle at that exact second. It moves from who are you to what are you doing right now?
It's incredibly clever. But I imagine there are some hurdles. I can't just sign up for this anywhere in the country, right?
No, not yet. This is a very targeted rollout. The plan officially launched in Arizona on January 26th.
Okay, so shout out to our listeners in Phoenix. You guys are the guinea pigs. Why Arizona, though?
Well, Arizona is kind of the Silicon Valley of self-driving cars. It's the testbed for autonomous tech.
Because of the weather.
The weather and the regulations, the laws are friendly to testing, and yeah, it's sunny and the roads are simple grids. Robots hate snow and, confusing old city streets. Arizona is the perfect sandbox.
That makes sense. Start on easy mode. Is it expanding from there?
Yep. Oregon is scheduled to follow a month later, so late February.
And that's it. Just 2 states for now.
For now. The source says there are 8 other states where Lemonade already offers car insurance. The expectation is that those states will join the program over time.
But there are regulatory hoops to jump through in every single state.
Oh, yeah. Insurance is regulated state by state. They have to prove to every single insurance commissioner that this pricing model is fair.
Right. Bureaucracy moves a lot slower than software. And just to be clear, this is only for Tesla right now.
Correct. And that's because of hardware and data limits. Lemonade basically said that currently only Tesla has enough safety data and that direct data streaming link to make this work.
Right. My Ford Fiesta isn't exactly streaming telemetry to the cloud.
Mm-hmm.
And even a lot of new cars from, say, GM or Toyota, do they even have an API an insurance company can plug into?
Generally, no. Or at least not easily. The legacy automakers have much more fragmented software. You have one computer for the engine, one for the brakes.
All made by different suppliers.
Exactly. Tesla is built like a smartphone on wheels. The software is centralized. That makes this kind of integration much, much easier.
So Tesla is the iPhone and Lemonade is in the App Store.
In a way, yeah. Lemonade wants to expand this to other self-driving vehicles eventually. But for right now, the Tesla ecosystem is the only one mature enough to support it.
So we have a company that was already doing well. They launched this product that basically says, we bet the robot is safer than you. And the market goes crazy. But let's talk about the strategy here. This feels like a massive gamble.
It is a gamble, but it's a calculated one. The underlying thesis is simple. Lemonade is betting that robocars will be significantly safer than human-driven vehicles.
And safer driving means fewer accidents.
And fewer accidents mean fewer claims to pay out. If I give you a 50% discount, but the accident rate drops by, say, 80% or 90%, I'm making way more money. That's the math they're betting on.
It's a classic disruptor move. The big guys, like Geico or State Farm, they can't just offer this. It would kill their revenue.
Exactly. And think about adverse selection. Lemonade is basically cherry-picking the best drivers, or at least the safest miles driven. They're recruiting all the safe drivers by offering them cheaper rates.
Which leaves the human drivers, who crash more often, for the other insurance companies.
Yes. The legacy carriers get stuck with the bad risks. That's a dangerous place for a competitor to be.
That is diabolical. I love it. You know what else is great about this story? The foreshadowing. Turns out the CEO of Lemonade, Shai Wenninger, was dropping hints about this way back in October 2025.
He was posting on, formerly Twitter, and actually tagging Elon Musk in the post. He was practically shouting, "We are going to do this."
And what did the market do back in October?
Nothing.
Nothing.
Didn't move the stock at all. At the time, investors they dismissed it. They figured it was a long-term strategy, maybe something 5 years out, or just a CEO trying to get attention from Elon Musk.
That's classic behavior. The CEO tells you exactly what they're going to do, and everyone just ignores it until the press release.
It really speaks to the difference between an idea and a product. In October, it was a tweet. In January, it was a real product you could buy, and that's when investors embraced it.
But let's play devil's advocate for a second. We've been painting a pretty rosy picture. Robots are safe, stocks go up. But our source material points out some real skepticism.
Right, and we have to be realistic. The source explicitly says it remains to be seen if real-world data actually proves robots are safer. We have assumptions. We have test track data.
But mixing autonomous cars with human drivers in chaotic Arizona traffic? That's a whole different ballgame.
It is. We've all seen the videos of self-driving cars getting confused by construction cones or the phantom braking incidents.
Where they just slam on the brakes for no reason because of a shadow on the road.
And those incidents can cause rear-end collisions. If the software glitches, that leads to claims.
So if the robots turn out to be glitchy, Lemonade could be in real trouble. They're giving a huge discount for a risk that might not actually be lower.
That is the risk. The data is still being written. This is a live experiment. If the FSD accident rates are near zero, Lemonade looks like a genius. If they're comparable to humans, then they're just giving away half their revenue for nothing.
That's the definition of high stakes. They're betting the farm on the software quality of a car company they don't even control.
But if we connect this to the bigger picture, think about what this does for adoption. We often talk about tech adoption being driven by the cool factor or convenience.
But really, it's driven by cost. Money talks.
If using FSD saves you $100 a month on insurance, you are going to use FSD. You're going to get used to it. This insurance plan might actually accelerate the adoption of self-driving more than any Tesla marketing campaign.
That's a great point. It creates a financial feedback loop. I use the robot, I save money. The robot gets more data, it gets smarter. The insurance company gets more data, it refines the rates. Eventually, using the robot becomes the default because it's just too expensive not to.
Precisely. And if the data proves the car is safer, this could be a turning point for Lemonade. They stop being the people who pay you when you crash and start being the people who pay you not to crash.
It's just a fascinating time to watch this stock. But everything really hinges on this rollout in Arizona and Oregon.
And remember the volatility. We mentioned the 52-week range earlier, $24 to almost $99. This is not a stock for the faint of heart. If there's one high-profile crash involving a Lemonade-insured Tesla on FSD, that stock could swing back down just as fast.
So let's recap. Lemonade stock is soaring, up almost 22% in January, over 138% in the last year.
And that surge is built on a foundation of solid earnings and improving loss ratios. But it was ignited by the launch of the Lemonade autonomous car plan.
A plan that charges Tesla drivers half price when they let the car drive itself, starting out in Arizona.
All driven by the thesis that automation is safer and supported by a direct data integration that traditional insurers they don't have yet.
It brings us back to that core question. For you, the listener, this matters because it represents a shift in how we're incentivized. We're moving from a world where you're rewarded for being a safe driver to a world where you're rewarded for just stepping aside and letting the machine handle it.
It's a profound shift in agency. We're being paid to surrender control.
I love that. Pay to surrender control. It sounds a little dystopian, but if it saves me 50 bucks, I'm probably signing up.
I think most people would.
So here's the final thought I want to leave you with. Let's fast forward a year or two. Let's assume the data confirms it. Let's assume Lemonade publishes a report saying FSD drivers crash 90% less often.
That would change everything.
If that happens, does this discounted plan become the turning point that forces all insurance to change? Will Geico and State Farm have to scramble to compete? Or, if the data shows otherwise, if the robots are just as bad as we are? Is this whole thing just a momentary stock spike based on pure hype?
That's the billion-dollar question. Is this the new standard, or is it a failed experiment? The market has voted with its wallet, but the roads will cast the final vote.
And we will be watching the ticker tape to see what happens. Thanks for diving deep with us today.
Always a pleasure.
We'll catch you on the next one. Drive safe or, let the car drive for you.
Take care.